Knowing what individual stocks to invest in takes a huge amount of time and introduces more risk than most people are comfortable with. That's probably why ETFs, or exchange traded funds, are so popular. They're easy. So, what ETFs are the largest these days? Well, here are the top 5 biggest ETFs measured by assets under management, and what's inside each one. Let's get started. VUG, full name Vanguard Growth ETF, holds over $118 billion in assets under management. VUG is an index fund that tracks the CRSP US Large Cap Growth Index. So the stock composition of the index is the stock composition of VUG. Because this is a passively managed ETF, the cost to own it is only 0.04%. Looking at some notable sector percentages, we see that over 56% of the fund is invested in technology, 19% in consumer discretionary, which are non-essential goods like luxury items, about 9% for industrials, and 7.5% in healthcare. Given that we're dealing with large cap growth, the individual stocks are going to be big companies focused on capital expenditure to innovate and to scale. So naturally, technology is going to be all over the place. 8 of the 10 top holdings are technology companies: Microsoft, Apple, Tesla, just to name a few. The only 2 non-tech stocks are the pharmaceutical company Eli Lilly and Visa. They represent only 4.55% of the entire fund. Let's talk about VUG's performance. What instantly pops out is the 1-year return, almost 32%. And that makes sense. Big tech has had a huge comeback since 2022. But focusing less on the short term, VUG has performed exceptionally well. 14.5% returns over the last 10 years, and almost 11% since the fund's inception in 2004. For inexpensive exposure to technology and big companies with growth at the forefront of their minds, VUG is a staple, and I'm invested in it myself. The Vanguard FTSE Developed Markets ETF, stock symbol VEA, currently manages over $131 billion worth of assets. The index it tracks is lesser known. Its full name is the FTSE Developed All Cap ex-US Index, and the FTSE part stands for Financial Times Stock Exchange Group. This index consists of countries outside of the US, including areas like Canada and Europe. And although this is more of a specialized field of investment, it's still not expensive to own this fund, with an expense ratio of just 0.06%. Looking at the fund's composition categorized by country or market, you get a feeling for where the bulk of investment is going. Japan at more than 20%, the UK over 12%, Canada close to 10%, and so on and so on. But what's arguably more important is the individual company holdings. It might surprise you to see some household names like Toyota, Samsung, Nestle, and Louis Vuitton. What's interesting is that the most heavily weighted stock is Novo Nordisk at just 1.68%. Huge contrast to something like the S&P 500. Now, the historical returns of VEA are not the greatest, at least not compared to our standard for US equities. The 5-year and 10-year returns are about 6% and 4.5% respectively, which are decent returns, but if you look at the returns since inception, 2.9%. That barely beats inflation. But the purpose of VEA in your portfolio may not be solely about total return. If you're invested in foreign companies, chances are it's first and foremost about hedging risk, diversifying your portfolio so that it isn't completely subjected to the swings of the American stock market. If the US is struggling, there's the scenario in which foreign countries are not. Invesco QQQ ETF, which, quite frankly, requires very little introduction. Famously known as the Qs, it has current assets under management of $257 billion. QQQ tracks the NASDAQ 100 index, a collection of the 100 largest non-financial companies in the US, predominantly technology. QQQ is a passively managed index fund, but its expense ratio is slightly higher than some others at 0.2%. Still relatively cheap, but not the cheapest. As I said earlier, the Qs consist mostly of technology. Nearly 60% of the fund is allocated to the sector, and the only other double-digit category is consumer discretionary. So by nature, this fund is biased towards growth companies. The top 10 holdings showcase tech's dominance here: Microsoft, Apple, Amazon, Tesla, the big tech players. But one exception being Costco, which I don't hate at all because Costco is an awesome business. But anyways, I digress. Performance is represented by a hypothetical investment of $10,000. If you invested $10K 10 years ago, it would now be worth close to $53,000. For comparison, the S&P returned $32,000 over the same period. For a wider picture, we have to go to the finer print. Here we find that the historical performance of QQQ since inception, which was over 25 years ago, by the way, was 9.7%. QQQ's popularity speaks to what investors get from the fund: exposure to tech and related industries, which are inherently focused on growth, innovation, and capturing the potential of new technologies. The Vanguard Total Stock Market ETF, stock symbol VTI, $390 billion of assets under management. This fund is exactly what it sounds like. It tracks an index of the entire US stock market: growth, value, large company, small company, all of it. And for a cheap price. VTI has an expense ratio of just 0.03%. If you ever wondered what industries dominate the value of the US stock market, just look at VTI's portfolio composition. The top 5 sectors are technology, consumer discretionary, industrials, healthcare, and financials. As for the top 10 holdings, big tech is a staple, of course, but take note of Warren Buffett's Berkshire and Eli Lilly. That's the pharmaceutical company that created a competitor to the Ozempic weight loss drug. VTI's performance, which is representative of the overall performance of the US stock market, has been exceptional: 12.3% and 11.8% for the 5-year and 10-year returns. And since inception in 2001, 8.4%. The strategy behind owning the entire US stock market is really basic, but incredibly effective. The idea is that in the long run, the market is efficient enough to bolster the winners and cast out the losers, essentially picking individual stocks for you. Rather than worrying about this sector versus that sector, or the longevity of a single company, or the impact of the economy on growth stocks, why not own everything? All you need to believe in is American enterprise and innovation. The largest ETF by far is an S&P 500 ETF, which should surprise no one. In fact, the top 3 largest ETFs by assets under management are actually all S&P 500 funds. VOO with $436 billion, IVV at $451 billion, and SPY managing $511 billion. That's a combined total assets under management of $1.5 trillion. These funds obviously track the S&P 500 index that represents 500 of the largest publicly traded US companies across several industries. And because they all leverage passive management, all are inexpensive. The expense ratios of VOO, IVV, and SPY are 0.03, 0.03, and 0.09%, respectively. The S&P 500 sector composition is similar to that of the entire US stock market, just with more financials and healthcare and less industrials. And the same could be said about the top 10 holdings: slightly different percentages, but still all the same big players. For measuring the long-term performance of these, it's best to use SPY, because it's the oldest. Since being founded in 1993, SPY has returned over 10% a year. That's double-digit returns for over 30 years. And that's indicative of the S&P 500's historical track record. Over a 70-plus year period, the S&P 500 returned double digits on an annual basis. This is exactly why the S&P 500 is the standard for all financial comparisons. Can your investment beat the S&P 500? Historically, that answer is probably no. Owning one of these S&P 500 ETFs says the same thing as owning the entire stock market. You believe in the long-term prospect of American enterprise and innovation, but without the more volatile side of smaller companies. My testament to the S&P 500 is that my portfolio is at least 75% invested in it. And there it is, y'all. The top 5 largest ETFs measured by assets under management. VUG for growth, VEA for non-US equities, QQQ for technology and growth, VTI for the entire US stock market, and of course, the S&P 500 ETFs to track one of the greatest investments over one of the longest periods of time. I'm personally invested in a few of these, but how about y'all? Do you use these for your portfolio? Any other ETFs that are similar? Maybe better? Let me know. As always, thanks for watching. Until next time, take care of yourself, and best of luck.